Cameraman 1.
2,
3,
4, 5.
6.
According to a Federal Reserve Board study, about 43% of American families spend more than they earn each year. You may be speculating, well, how is this possible? The answer is through the use of credit cards. Credit card debt plagues many American households. Statistics show that over the past decade, credit card debt has increased by 25% in the U.S. Nearly half of all Americans that use them carry an average balance on their cards of more than $7,000. One significant cause for these problematic figures stems from banking practices that have been described by the White House as unfairly and deceptively complicated. In order to tackle the problem, President Obama enacted the Credit Card Accountability, Responsibility, and Disclosure Act of 2009. So today, I'm going to explain the significance of this act, discuss the new provisions it requires banks and credit card companies to follow, and detail how they can benefit you and your family. The Credit Card Accountability, Responsibility, and Disclosure Act of 2009, which is also referred to as the Credit Card Act, is a federal law that was passed by Congress and signed by President Obama in May of 2009. It was just recently put into effect February 22nd, 2010. That date in February marks the day in which the most sweeping changes to the credit card industry were implemented in over 40 years. The purpose of the act is to reform the credit card industry by regulating unfair practices that have been used by banks and credit card companies in order to make a profit. The new law shields consumers from a variety of different issues regarding interest rates, fees, term modifications, bill payments, and various other measures that have been used in order to cause individuals to inevitably default on payments. By banning some of the old practices used and instituting new provisions to follow, the Act provides credit card holders with new protections against unmerited changes or adjustments to their credit card terms. While there are numerous reforms made, I will discuss a few of the most significant changes you should be aware of, in that they will probably be the most beneficial to you. One of the key elements of the Credit Card Act is the ban on arbitrary interest rate increases, including retroactive rate increases. Retroactive rate increases allow credit card companies to raise interest rates on purchases made in the past, and therefore affect your outstanding balance. With the new law, these interest rate hikes on existing balances is not allowed, except under limited conditions, such as if you're on a variable rate plan, if your promotional rate ends, or if you are more than 60 days late in making a monthly payment. Also, banks and card companies must now give a 45-day notice for any rate and fee increases that will apply to new balances. Just as card companies still have the right to make changes to your accounts with notice, consumers now have the right to opt out or reject certain significant changes in terms of their accounts. Under the new law, consumers must now be given the option to close out their accounts and pay their remaining balance based under the old terms if they are unsatisfied with new changes. In that case, you would then have at least 5 years to pay off your remaining balance. Another important provision in the Credit Card Act is the requirement of card companies to show on each statement how long it will take to pay off a balance. A monthly credit card bill will include information on what it will cost in interest if you only make the minimum monthly payments, and furthermore, how much you would need to pay each month in order to pay off your balance in 3 years. This provision allows consumers the ability to better analyze their bills and see clearly just how much they are paying in interest each month. Many credit card users have accounts that carry different interest rates for different types of purchases. Before the implementation of the Credit Card Act, consumers were required to pay down the debt with the lowest interest rate first, thus extending the time it takes to pay off higher interest rate balances. However, one significant provision included in the Act provides that any monthly payment that exceeds the minimum payment due must be applied to the balance with the highest interest rates. This provides relief to credit card holders in helping them avoid building debt with elevated levels of interest, and in turn will help them pay down their debt much quicker. There are many other reforms that have recently been enforced thanks to the Credit Card Act, including protections for young consumers, requirements for clear dates and times for monthly payments, and also restrictions on over-the-limit transactions. While the majority of provisions went into effect February of this year, there are a number of others that are going to be put into practice this coming August. Anyone that owns a credit card should be familiar with these new regulations in order to protect themselves and also to understand all of the new options that are available to them. These implementations put an end to many unfair practices that have been used by banks and credit cards and have wrongfully affected many responsible consumers.